Hi, Andrew McNair here. We're continuing our video series on investing, so thanks for watching. Warren Buffett gave this advice about investing. He said, rule number 1, don't lose money. Rule number 2, don't lose money. Today, we're going to talk about the practical rules that I would encourage you to abide by as you start investing. Whether you've been investing for years and you are a veteran investor, or you're just getting your toe in the water, this video is for you. You're going to take away some really tangible rules. So my first rule, number 1, is have an investment goal. Don't start without a plan or you'll never be successful. And you might be thinking, I'm asking you to set a goal for how much profit you're looking to make on an investment or what the goal is for you to have for retirement. No, this isn't about how much you want to have or make. It's about a goal of how much you plan to invest per month. An ancient proverb says, the plans of the diligent lead surely to abundance, but everyone who is hasty comes only to poverty. It's important that you set aside 20% to long-term investments. You have to have a plan and be diligent to set aside that 20% to invest. It's not just going to happen. The best way to do this is to decide how much of each paycheck you want to designate towards investing. 20% is the number. Jesus once said, one who is faithful with very little is also faithful in much, and one who is dishonest with little is also dishonest in much. Luke 16:10. The key is to be faithful. Although it might not seem like you're investing much at first, think of that amount as seeds that will grow into a harvest down the road. Even if you're just taking 20% of your small salary today, that habit, as it grows and is leveraged as your income grows, will be amazing. To help you reach your goal, set up an automatic transfer each month from your checking account to your Roth IRA to your 401k so that it's out of sight, out of mind. That way, it's less tempting for you to spend that money, and it's specifically earmarked for investing and investing in investments that you cannot touch until retirement age. Rule number 2, diversify your investments. The key to investing is diversification. It's the free lunch. I mentioned it in a recent video that investing is risky. It has risks. The single most important thing you can do to help mitigate and navigate risk is to diversify your portfolio. This means maintain the right portfolio mix. And we'll get into how do you do that in a minute, but even the Bible says to diversify your holdings. Solomon, the richest, wisest man, Ecclesiastes 11:2, he said, invest in 7 ventures, yes, in 8. You do not know what disaster may come upon the land. This means life is uncertain, and so is investing, and you don't know what's around the corner, and you don't know what's going to work. So it's wise to spread out your wealth, but you don't know which venture will fail and which will succeed. Put a lot of eggs in one basket and watch that basket. Watch it like a hawk. So how can you make sure our accounts and investments are properly diversified, you might be asking? You might say that you're diversified if you have money in a bunch of different mutual funds or ETFs, which are exchange-traded funds. But I'm telling you that true diversification means spreading your money around in different asset classes altogether. That won't settle for just mutual funds and ETFs. It will all move the same way. So that's why you have to have different asset classes that navigate these headwinds and tailwinds like a sailor in the water. So don't think of your investment as a soup pot where you throw in different ingredients, but more like a lasagna, layering in different asset classes to be truly diversified. Diversification and time cure a lot of sins and mistakes in investing. That brings us to rule number 3. Make your investments boring. Don't let your emotions dictate the rules. Paul Samuelson was the first American to win the Nobel Memorial Prize in Economic Sciences for his fundamental contributions to nearly all branches of economic theory. He said, investing should be more like watching paint dry or watching grass grow. If you want excitement, take your $800 and go to Las Vegas. And that is so true. We are not speculating. Let gambling be for the unwise investors. We're investing. Investments have to be custom to you. So I can't tell you exactly what you should invest in, but for a 30-year-old today who's wanting to invest in the stock market, here's an example portfolio. Now, this might seem too overly simple. too boring and not enough exciting pieces in the puzzle. But I assure you that you want vanilla when it comes to your money. If someone is giving you this brand new fly-by-night investing strategy or telling you you can become a millionaire by day trading, be wary. You want to look for a boring investment strategy. And I'd rather have a boring investment strategy so I can have a wildly adventurous bucket list filled life and retirement. Rule number 4, do regular checkups. There is no such thing as a set it and forget it in investing. One of the most important things that you can do to mitigate risk is just rebalance your portfolio, rebalance your investments to keep those allocations consistent between asset categories, because certain XYZ funds will grow faster than the others. So it's important to sell the winners to buy more losers and vice versa. This way you'll ensure you're on track for retirement and other investment objectives. Now, overall, expect to revisit your investment style and approach every 3 to 5 years or when you have a major life change. Now, over an 8-year period, the British cycling team won 16 gold medals and 7 Tour de France wins. Credited for their success, the team used the theory of marginal gains. The theory goes that if you just make a 1% improvement in a host of tiny areas, the cumulative benefits would be extraordinary. And they proved that. This theory lends itself really well to investing. When my clients come in for our hedge fund and our wealth management firm, we do a stress test on their portfolios. And there are so many tiny tweaks that they could make, such as maybe they're not as diversified as they think. They need more in large companies, medium-sized companies, small companies. Are they too heavy in the tech sector versus the financial sector? They need to be very diversified. Are they too heavy in domestic stocks instead of also having international stocks? Are they paying too much in fees? Just 0.25% too much in fees can cost you a lot. All of these small incremental changes can make a world of a difference. So those are the 4 rules of investing that I wanted to share with you to help you get started. Follow those rules and you will avoid mistakes others, even really smart investors, have made. When I help people with investing strategies, I always think about the best time to plant a tree. The best time to plant a tree is 10 years ago. The next best time is when? Today. So don't worry about making more money. Don't worry about the mistakes you've made. Don't worry about knowing more about investing. Don't worry about picking the right investments. Don't worry about making more before you invest. Invest 20% today of your income, and you'll be glad you did. For most of my life, I have been greedy. And if you want to hear my story from greedy to generous, how I've given away most of my net worth, pick up a copy of The Giving Crisis by going to richyoungandpowerful.com. That's richyoungpowerful.com to hear my story and get tangible tips on how you can be generous as well. Also, click subscribe so you don't miss our new videos coming out. And check out my podcast, Rich, Young, and Powerful, to hear from athletes and musicians and these influencers that are using their platform and resources to influence greater missions. Until next time, remember to invest your life into something that will outlive it. Now that's living the give.